In 2021, millions of everyday people bought a stock called GameStop. Not because the company was doing well, not because some genius analyst told them to. They bought it because everyone else was buying it. And in a matter of days, some people turned a few $100s into tens of thousands. But here's the part nobody talks about. The majority of those same people held on too long, watched the price collapse, and lost almost everything. They didn't lose because the market was unfair. They lost because of what was happening inside their own heads. And by the end of this video, you are going to understand exactly why and how to stop it from happening to you. Your brain was not built for investing. It was built for survival. Thousands of years ago, when you heard a loud noise in the forest, the smart move was to run first and ask questions later. That instinct kept your ancestors alive, but in the stock market, that same instinct destroys wealth. Because when prices drop, your brain screams danger and you want to run, which means selling at the worst possible moment. When prices are shooting up, your brain sees a reward and wants to chase it, which means buying at the worst possible moment. This is not a flaw in the market. This is a flaw in how humans are wired, and the first step to fixing it is knowing what these mental traps are actually called. Let's start with the most common one. It is called herd mentality. And it sounds exactly like what it is. When everyone around you is doing something, your brain assumes it must be the right thing to do. It is the same reason a store with a line out the door seems more appealing than an empty one. In investing, herd mentality is what drove GameStop to absurd prices. It is what fueled the dot-com bubble in the late 90s. It is what caused the housing market crash in 2008. People were not being stupid. They were being human. They saw others making money. They felt the fear of missing out. And they jumped in without asking the most important question. Why is this asset actually worth buying? The second bias is sneakier. It is called anchoring. Imagine a stock was trading at $200 6 months ago. Today, it is at $80. Your brain immediately says, wow, that is cheap, it is on sale. But that original $200 price is just a number your brain decided to anchor to. It does not mean the stock is actually worth $200. It might be worth $50. It might be worth $10. Investors lose serious money because they anchor to a price they once saw and use that as their baseline for what is fair value. The market does not care what a stock used to cost. It only cares about what it is worth right now and what it might be worth in the future. Now here is a bias that feels like confidence but is actually dangerous. It is called confirmation bias. Here is how it works. You decide you want to buy a stock. So you go online and you read every article that says it is a great buy. You join Reddit forums where people agree with you. You watch YouTube videos from people who are bullish on it. And you completely ignore every piece of evidence that says the opposite. You are not doing research. You are building a case for a decision you already made. This is confirmation bias, and almost every investor falls into it at some point. The fix is simple but uncomfortable. Actively seek out the bear case. Find the smartest person who disagrees with you and actually listen to them. Let's talk about loss aversion. Studies show that losing $100 feels roughly twice as painful as gaining $100 feels good. Read that again. The pain of a loss is psychologically about twice as powerful as the pleasure of an equivalent gain. This is why people hold on to losing stocks way longer than they should, because selling means making the loss real. As long as you haven't sold, you can tell yourself it might come back. This is also why people cut their winners too early, locking in a small gain because they are terrified it will disappear. Loss aversion causes you to do the exact opposite of what successful investing requires. You end up holding your losers and selling your winners. Here's one that is going to sting a little. Overconfidence bias. Studies consistently show that most people believe they are above average drivers. Most people think they are smarter than the average person, and most retail investors think they can beat the market. Here's the data. Over a 15-year period, more than 90% of actively managed funds fail to beat a simple index fund. And retail investors, on average, underperform the market by about 1.5% per year just because of trading costs and bad timing decisions. Overconfidence leads to overtrading, taking on too much risk, and ignoring warning signs. The best investors in the world are obsessed with what they do not know. That is the mindset shift that changes everything. Now let's talk about hindsight bias. After the 2008 crash, suddenly everyone knew it was going to happen. After Bitcoin hit $20,000 and crashed, everyone said they saw it coming. After any major market event, the internet fills up with people saying they called it. Hindsight bias makes us believe the past was more predictable than it actually was. And that is dangerous because it makes future events feel predictable too, when they are not. If you walk away from a bad investment thinking, "I should have known better," you might be setting yourself up to be overconfident next time. Sometimes markets do genuinely unpredictable things. Accepting that uncertainty is a core skill in investing. There is one more I want to leave you with, and it might be the most relevant for your generation. It is called present bias. Present bias means you value what is happening right now far more than what will happen in the future. It is why you order the burger instead of the salad. It is why you spend money today instead of investing it for 30 years from now. In investing, present bias shows up when people panic sell during a short-term downturn, even though they have a 20-year time horizon. The short-term pain feels so real and so immediate that it overrides the long-term logic. The antidote to present bias is visualization. Literally, imagine your future self. Research shows that people who vividly imagine their future self make significantly better long-term financial decisions. So here is what we covered. Your brain is running ancient survival software in a modern financial world. Herd mentality makes you chase the crowd. Anchoring traps you in irrelevant numbers. Confirmation bias turns research into self-deception. Loss aversion makes you hold losers and sell winners. Overconfidence leads to expensive mistakes. Hindsight bias creates a false sense of predictability. And present bias pulls you away from the long game. Knowing these biases will not make you immune to them, but it creates a pause, a moment between the emotion and the action, where better decisions live.